much of your time. I would like you to just go through the webinar flow. So we will be discussing some of the initial indicators. So there are a lot of indicators available on the homepage itself for you to gauge the market movement. These initial indicators are very good and relevant in the present scenario. There is one option data indicator specifically for Nifty data we have provided. So what it does and how to really comprehend the data, we will be discussing that particular aspect also. Then we will be moving to understanding the open interest. Many of you, I know that are very well versed about what is open interest and how to look at open interest and what all things. But at the same time, I sense that many of the market participants or the participants in this webinar are not too sure about what to expect out of open interest, what is open interest, and all sorts of things. Then we will be moving on to option analysis. And believe me, we are discussing derivative analysis. So derivative analysis has two aspects to it. One is option analysis and another one is future analysis. And the whole concept is complete only when you combine both these segments. Lot of times we have seen that many market participants or retail clients especially either focuses on option analysis very much, or they completely ignore option analysis and they trade on future price action analysis. So when we are talking about derivative analysis, we should give equal importance to option analysis as well as your future price action analysis, which we will be discussing after option analysis. So rest assured that you, by the time this session ends, you will have roundabout a complete information on what to expect out of each and everything in Auto Trader as regards to market analysis and option trading or future trading or derivative trading in nutshell. After understanding option analysis, we will be understanding the much talked about PCR analysis and what is difference, which is given on the derivative page on Auto Trader. So PCR, I know that it is vastly talked about subject ever since the lockdown happened, and there are a lot more material available on YouTube. Many of us are very well aware of the PCR. So what new we can bring is the whole discussion point over here. So we will be discussing that. Then we come on to the VWAP theories and how we can use VWAP. VWAP is volume weighted average price. So how we can use the VWAP analysis to make our future price action analysis much more easier to understand. So this is about introduction to VWAP. Then taking index trade, how we should take, what will be the strike price selection. Strike price selection is very important. Even if you are an option seller or even if you are an option buyer, strike price selection is very much important. And in different scenarios, different strike price selection is can be a game changer when it comes to your profitability. Sometimes what happens is a market moves up or down depending upon the weakness or strength in the market, but your option price doesn't move in accordance with that. So why it happens, what you should be aware of, what should you not do in such a situation. So we will be discussing that. Target SL and trail SL, how to do it and how you can maximize your limited resources, that kind of a thing we will be discussing. Yesterday's trade, and if we have enough time on our hands, then we will be discussing the possible strategies one can look forward to when you see yesterday's type of market. Because on one hand you had Nifty really pressurizing the whole broader market. And on the other hand, Bank Nifty was much more stronger yesterday in terms of delivering the overall trading setup. Then recap and question and answer session to wind off. So before going into the analysis, let's talk about various terminologies which we will be using or you might be using in your day-to-day life. Derivative segment. Again, I've earlier told you that it's a combination of option segment and future segment. So you need to give equal importance to option analysis as well as future analysis when you are doing derivative analysis. Otherwise, if you are doing only option analysis, then I'm okay with you doing option analysis, PCR analysis, and all sorts of things. And if you are doing future price action analysis, then I'm okay with you trading on charts or doing a lot more stuff other than the option analysis. So that is the thing. Strike price is the price at which a call or a put option can be exercised. So when you are an option trader, you very well know that there is a spot price, and according to the spot price you can choose any strike price. Like these, if the strike price, if the spot price is 18,650 right now, so you can very well choose 19,000 call option also to trade in, and you can also choose 17,800 put option. That is completely your choice, your assumption of the market. But the strike price, the definition becomes that, okay, at this price, the option can be exercised. That is a different story. Whether you want to get it exercised or not, that is a different story altogether. But this is the definition we are talking about. What is open interest? Open interest is the number of total contracts open in the market that has not been settled. So if I have a buy in 18,800 a call option and I have not settled that, so that means I have not squared off that particular trade, that becomes my open interest. And similarly, if you have sold 18,800 call option or 18,600 put option, which you have not squared off, then obviously that is an open interest. And how that open interest really translate into our option analysis, we will be discussing about the same. Change in OI. Change in OI is the total fresh positions opened or closed for the day. So what is happening today is much more important, and how to do analysis on that part, we will be discussing it, and we will be analyzing it through change in OI. So the current activity in the open interest will be indicated through change in OI. So change in OI is very important for all those who are trading on intraday basis. So almost according to the poll, around about 80% of the participants are of intraday nature. So change in OI becomes a very important segment to look forward to. Volume traded. So often people confuse the open interest with volume traded, or change in OI with volume traded. Volume traded is all about knowing the total buy transaction and sell transaction that has happened over the period. So volume traded is very much important because it becomes a very important part of your VWAP, volume weighted average price. So that is you need to look forward to. PCR. So PCR is nothing but your put writing divided by call writing. I will come to that point later, that why I'm referring it to as put writing divided by call writing. Why not put buying divided by call buying? It's because of some perspectives which we need to understand while we are trading derivatives, and that too when we are looking at option analysis, why we are making things from the seller's perspective, why we are not doing analysis from buyer's perspective. So that is the thing. Difference is your put writing minus your call writing. When I talk about PCR, it is division. When we are talking about difference, we are subtracting put writing minus call writing. So put writing minus call writing may give you a positive indication, or it may give you a negative indication. So that you need to understand. Option selling and option writing are one and the same thing. Many of us do confuse that option selling is when you buy an option and then sell, and option writing is when you short when you are shorting the options. Nothing of that sort. Option selling and option writing are one and the same thing. So you need to understand from that perspective. Addition is any new contract that has been added. So a lot of times you might have noticed that our media personalities or the anchors of the media are telling you that a lot of open interest have been added on this particular call and unwinding happened in this particular call. What is this? It is the new contract been added. When I say that a lot of open interest has been added onto, or addition has been taken place. Unwinding is closing out the existing position. So whenever I have a position, say I have a position at 18,700 call option and I close that position, then it becomes an unwinding. VWAP is volume weighted average price. So we will be discussing a lot more in detail about this particular aspect. So this is the option metric. Typically, it looks like this, that if you are long, in call option, that means you are bullish. Okay. You are expecting the price movement to go up. If you are long and you are having a put, that means you are bearish. That means you are expecting the market to go down. This is a simple matrix. A lot of people know about it. But as I've earlier told you that I'm doing this webinar, a detailed webinar, just to make sure that those who do not know or those who have less understanding on this subject are also in sync with all of us. So option writing, if option writing or selling, if you are selling a call option, that means you are either bearish or neutral on the market. So why it is important that neutral has been added to this? Because if you are selling the call option, you can make money if the market remains sideways or neutral, or it is bearish. So you have a larger probability of making money if you are shorting an option. Similarly, if you are shorting a put, that means you are bullish on the market or you are neutral on the market. So you are expecting a big range or a broader range or a tight range, or you expect the market to remain sideways or bullish. So your expectation when you short any put is that market should either rise or be in the same range with a positive biasness. When you short a call, you have a biasness which is negative in tone. Fine. So that is some of the basic things which I have discussed. And one of the important things which we'll be covering in the next slide is the open interest. So open interest is not dependent on buy or sell. If you look at this particular matrix, any open contract, either buy side or sell side, is one contract which is open. Like Anuj, as a market participants, have 7 lots of buying interest. So 7 open interest. Dhiren again has 12 lots. So total 19 lots are open in the market. At the same time, sell side Kshitij has 9 lots, Ajay has 2 lots, and Ravi has 8 lots. So if you combine those things, 9 to 11, 8, 19. So buy also 19 and sell also 19. So open interest is 19 because it has not been closed. So any closure of the contract would either decrease, and any addition in the contracts will increase the open interest. So that is the whole scenario which we'll be talking about. So let's move on to the ultimate software and how we can just make use of it and other things to discuss. So this is typically the login page. You would be aware of this, that just log in to the software, and this is the homepage which is presented over here. So right now you can see some of the initial indicators which we were talking about is your Nifty data indicator. So Nifty data indicator or Bank Nifty data indicator are the future data indicators. So they are reflecting the future data, how it is been poised for you. So right now, if it's a red quantity, it is a weakness, a sign of weakness, or it is weakness in the market. So you can see 2,48,500 quantity in red. So this is a classic signal for you to be bearish on the market from one of the aspect. You are dealing with a dynamic market. You need at least a checklist to be sure on what you are referring to. Okay, so whether you sense the market to go down or you sense the market to go up should not be based on one single aspect or one single theory, but it has to be a combination of different factors, and a checklist needs to be maintained. Otherwise you will fall prey to traps, or you will fall flat in the market. So these are some of the things which you need to understand and make a checklist. So first checklist gives you a information on Nifty is weak, whereas Bank Nifty is stronger, and why it is why you need to pay attention to these things, because it can give you some early signs of any reversal or further movement in the market. So right now, if you see Bank Nifty data indicator, it has a very low quantity. Any quantity which is below 50,000 in terms of a highly liquid index, whether it is a Fin Nifty or Nifty or Bank Nifty, if this quantity is below 50,000, that can be easily reversed. So you need to have more than 1 lakh quantity to really give you a sense of direction. So here, if you see, Nifty data indicator has 2,48,000 negative quantity. So this is a sign of more confidence in the market as to weakness in Nifty. Here in Bank Nifty, I'm not too sure. It may be just the half an hour adjustment which has brought Bank Nifty in positive, but it is a very low quantity as far as the whole Bank Nifty liquidity goes. So any quantity which is above 1 lakh has a significance in your analysis. So for all the analysis, we need to understand that first you need to make a checklist. So we have made a checklist that Nifty is weak, Bank Nifty is slightly positive. Then coming on to the second aspect is the market balancer. Market balancer gives you a broader perspective of looking at the market. These are the stock sentiments. Out of 190 odd stocks in F&O space, yesterday 147 stocks had a negative tone to the market. So they were showing some sign of weakness in the market, and only 29 stocks, hardly 29 stocks were positive. So you can think of it as an advanced decline ratio. So how you treat advanced decline ratio, the same way you can treat the market balancer, and it gives you a very good perspective to the market. Why? Because index alone cannot move. It is the stocks which moves the market. It's not the other way around. Many people or many retail investor think that markets move the stocks, but in reality, when your stock moves, then only your index will move. Index is a derivative of stock movement, you can say. Then in the market summary itself, your Nifty PCR signal is suggesting a sell and Bank Nifty signal is suggesting a sell. So you are now confident enough that out of 3, at least 2 indicators are suggesting that I have a negative tone to the market. Fine. So let's move on to some of the other checklist points. The fourth checklist point is your index sentiment. So when I talk about index sentiment, I talk about sectorial strength in the market. Why sectorial strength? Because each and every stock in the market belongs to one or the other sector. So if you are talking about how Reliance is looking, I need to track energy sector. So if Reliance is down, then obviously the energy sector has to be down. So if I look at the broader perspective, broader sentiment of index, then I can gauge some or the other market movement. Fine. So auto stocks were down yesterday. Banking, private banking space were completely down, 96 to 3. Energy 74 to 25. Only the saving grace was pharma, which has a positive inclination. Otherwise, all the other indexes were down. So another way of looking at the market was that market was weak. Fine. So that's the point. Then again, I come to the front. Here you can see midterm checklist, trend midterm checklist. All the way we are talking about the intraday setup. Your Nifty data indicator is an intraday setup. Your Bank Nifty data indicator is an intraday setup. Index analysis is intraday. Market balances is intraday. Your Nifty, Bank Nifty PCR is intraday. But this is the positional aspect. So positional is very important when you trade on an intraday basis, because you need to get sense of the market, that how the market is behaving and where to stop your trading, where to expect any kind of reversal or not to expect any kind of reversal. The answer comes from this midterm checklist. So what midterm checklist gives you is Nifty bulk average is 18,580. So as long as your Nifty remains above this particular level, I'm talking about future Nifty, 18,580 levels, you can be a positional buyer of the market, not of the option, but the markets. You need to understand that Nifty is buy on dips till the time it doesn't break below 18,580 levels. At the same time, Bank Nifty yesterday or day before yesterday has turned negative. Now you can have a sell on rise strategy in Bank Nifty as long as it sustains 43,874. Right now it is trading at 43,722 or 701 in future terms. So till the time it doesn't cross above 43,900, you need not to take any bullish position from a positional perspective. You are free to do a bullish trade if you are trading on intraday basis, because intraday trading is not really affected by the overnight exposures or other aspect. But when you do positional trades, that becomes a very important tool. So this is very important. Now coming on to some of the very good features which we have introduced in our whole setup is your midterm checklist has all the values related to future data. So we are not talking about spot, we are talking about future. And as the monthly expiry nears, only 3 days are left because 28th is off on account of Bakra Eid. So we have the spot and future premiums coming down. Okay, so let's see how the progression happens. Now coming on to one of the very good very good factor or very good checklist is your option data indicator, which we have presented for Nifty and only for Nifty. And how it works is that you have your money flow data. Money flow data is different from your open interest. Money flow represent the market activity. What people are actively doing in the market, it represents that particular aspect. Open interest is altogether a different ball game, which we will be discussing in a little short while. So first of all, I would like to tell you that Nifty weekly 18,600 C5. So what it is, Nifty is Nifty, W is for weekly because it's a weekly contract. It is a separate thing that monthly contract and the weekly contract this time coincides. So, but the structure remains the same. So 18,600 is the strike price. C5 stands for call. C stands for call, and 5 stands for weekly contract, 5th week. So this is running 5th week. So we have 5 expiries this time, 4 weekly and 1 monthly. So right now you can see that if you see the total combined value, it gives me a negative value on the money flow, call money flow. So people were taking out money from call options and putting their money in put options yesterday as far as Nifty goes. So what people, market participants did was they pulled out money to the tune of 1,90,05,400 from call options. And at the same time, they were very aggressive in buying put options to the tune of 3,30,71,100. So this is this particular checklist shows the market activity and how it really works. So I have a little matrix. So I have a little matrix to look forward to, and just to make you understand how the things work. So this is, oh, sorry. So this is the matrix you should be referring. I hope everybody sees this matrix. If you have buying in call option, so buying quantity in call option, that is a positive quantity in call option, and selling in put option, that means a negative quantity in put option, that is a sign of bullishness. Fine. If you have selling in call option, that means the same situation that we had yesterday. We had selling in call option, that means there was negative quantity in call option, and you have buying in put options. As you saw that 3 crore some put buying was there, then it is a bearish sign. The third scenario is both call option and put option are having a buying quantity. That means either the market participants are having an indecision that whether the market will go up or down, that they are not really finalizing as yet, or there is some kind of an event coming in the week. Okay, so sometimes what happens is just the day before any major Fed event or RBI policy, you see a lot of calls and puts being bought. Why? Because people think that there will be huge volatility in the market and we can encash that volatility through option buying. Option selling, call option selling as well as put option selling comes when you have a situation where the market is sideways to the tune of like 30 points or 35 points either way direction, and no proper trend being emerged. So you have a sideways market, so people do tend to make use of theta decay and try to make money out of it. So sideways market, or sometimes what happens is you have a very high premiums on account of say a Friday is typically high premium scenario where it's a start of the current week and you have a Saturday and Sunday coming along. So people tend to short those call and put just to make sure that Saturday, Sunday, they enjoy the benefit of high premium decay, and on Monday they'll cover those things. So that is the scenario which we are looking forward to. Typically these two scenario comes in focus most of the time, and these two scenarios, the bottom two scenarios, comes very often these days, but they are less in numbers than the above two. So you need to make sure that which matrix you come into. So let's go back to our home page. So this brings me to the end of the first thing, which is the initial indicators. We will be discussing about it in question and answer session later on. If you have any difficulties in understanding one or the other subject matter, you can always note down certain questions and then we can discuss later on. Coming on to the advanced level theories, first of all, I would like to tell you that in the derivative section, just left hand side, you can see a drop down menu is coming. If you just scroll down, there are a lot more things to look forward to. Nifty OI table, Bank Nifty OI table, Fin Nifty OI table for current week. So that we are giving you. We are also giving you Nifty OI table for next week. So the current week goes by and the next week comes along. So next week, today is obviously Saturday. So you might not get the next week, but in the any working day or any other day, you can always find Nifty OI table for next week. So 29th June, current week data is available over here. Then we have your Nifty OI table monthly and Bank Nifty OI table monthly. So this time round, monthly data and weekly data are one and the same because we are running into the monthly expiry itself. Then we have the various charts to make your understanding much more easier. So how it works: Nifty OI charts, the first half is for your positional understanding, and the second half, as I've already told you, that change in OI is intraday data. How it develops, we need to understand and act accordingly. So same way Nifty and same way Bank Nifty, we are giving you that particular thing. So this is all what we need to understand. This is all what we need to make sure that we gain confidence and conviction in analyzing those things, and ultimately trying to take advantage of this analysis and do trade executions based on this analysis. So just for understanding purpose, the concept which I will be explaining, or the PCR concept or the VWAP concept, are universal in nature. And because they are universal in nature, they are best fit in any situation, whether you are talking about FinNifty, Bank Nifty, Nifty, or even stocks. You can apply those concepts universally everywhere. So it is not restricted to, like, if I'm explaining you with a Bank Nifty reference, then it is not that it will only work for Bank Nifty, it will work for Nifty, it will work for FinNifty as well. So let's begin our analysis. So first of all, before doing this analysis, again, I would like to tell you that we have divided this particular page into 3 sections. First section, Bank Nifty option or any Nifty option. Left hand side, you have all the call writing data. And on the right side, you have all the put writing data. Okay, so complete option analysis is presented over here. Fine. Then the second, which is of much more importance to all the intraday traders, for positional traders, which accounts for 20% of the total participation in this webinar. There are a lot more things to look forward to, but as far as the intraday trader goes, this particular section is very important. Why? Because this reflects the change in OI, and we are also giving you the past reference data right from 9:30 to 3:30, how the data changed. We are just presenting that data to you. And this is the process data. Process data in terms of, we are giving you PCR analysis at every 15 minutes interval, or if you are an aggressive trader, then you can always choose 5 minutes interval also. So how the data is progressing at every 5 minutes, you can always look forward to. And if say if you are an aggressive trader, you know your risk profile very well. If your position size is large enough for you to manage the little spikes in the markets, so that for that purpose you need 5 minutes. But as far as any beginner or any trader who is a moderate risk trader, or who trades in 1 or 2 lots like me, then obviously 15 minutes is good enough. I will be concentrating more on 15 minutes than on 5 minutes, just because I want to cater to large number of audience. So this is every 15 minutes data. This is a process data, as you are aware of the fact that from 9:30 to 3:30, we are posting call writing data and put writing data for every 9:30 price point, 9:45 time point, 10 o'clock, 10:15, and we try to gauge the market movement based on this particular aspect. We need to analyze. This is a very famous saying, that we analyze the past, we learn from the past, apply the learnings from the past in the present, and we make our future better. So this is a famous saying, and that is what we are really developing this thing, and we are concentrating on each and every past data to make a proper analysis of what to expect in the trading. So so we will be discussing on the left hand side. You can see till the option signal, it is the option analysis, and right hand side you can see VWAP price and VWAP signal. This is the future price action analysis, and we will be discussing that thing little later. But before that, I would like to tell you that this is the third section. Many of you might have seen this section. I'm aware of that, but how to use it and how better it can be while you are setting up your trades, I'll just show you. Nifty intraday trend and Bank Nifty intraday trend. It gives you a pictorial representation, and believe me, if you have seen this Drishyam movie, then it says that when you visually uh, sense something, that is much more relevant for you than to do a proper analysis and proper tabular analysis and other things. So pictorial representation has a very far-reaching consequences when it comes to your trade setup. As you can see, yesterday intraday trend, it was clear that right from the very beginning, Nifty was very weak, and throughout the day it was sideways. So that is one big thing which has come out of it. Look at the trajectory of the opening. It opened fairly well, but then it slides towards negative till 10, and it becomes a sideways kind of a movement over here. So there are certain spikes in the market, but then it was the weakness in the market which persisted, and it pulled down the Nifty altogether. But it was much more sideways movement where you need some other strategies to look forward to in order to make money. Some of the smart traders or some of the professional traders might have done short selling in the options. Some of them have made credit spreads, diagonal spreads, and all sorts of things to make some sense in the market, trading Nifty. And on the other hand, you see Bank Nifty really performing really well till a point. Again, it was sideways from this point to this point, and eventually later in the day, post 2 o'clock, it just slided down just because it was a Friday. There was a weekend, there was a truncated week coming along. So a lot more things have affected the market movement. But looking at this chart, one thing was pretty sure, that Bank Nifty was stronger than Nifty yesterday in terms of overall market setup. So this is the section. So now just I'll come on to the whole concept of open interest. So as you know, open interest is all the contracts which are open in the markets, which has not been settled as of now. Fine. So when I do option analysis, why it is important that I pay respect to the sellers. So all the option analysis is from the point of view of sellers. So you can see the data, the left hand side data belongs to call writers, and right hand side data belongs to put writers. Why? Because you need to understand one thing: when you are trading in future, then both the parties are taking equal amount of risk at the same time. Fine. So if in future I buy a lot at 100 rupees and you are selling the lot at 100 rupees, we both are having the same amount of risk and we both are obligated. Fine. So if that particular future rises from 100 rupees to 105, I as a buyer will make profit of 5 rupees, and at the same time you as a seller will lose money at the same time. So our risk matrix is equal in that sense, and if the particular price goes down, then I will lose money and you will make money at the same time. But when it comes to option analysis, the things changes. Why? Because if I am an option buyer, what I am essentially doing is, this is very important, so try and understand this thing, that if I am an option buyer, what I am essentially doing is I am transferring my risk to the seller by just paying a token amount. The token amount, say if I sense that market will rise in the next week till 4,400 or above 4,400, I might give the seller 98 rupees or 100 rupees. So what I am trying to do is I am giving 2,500 rupees to the seller and transferring my risk to that seller. So that my side of risk is being taken care by the seller. And what seller is doing, essentially, he is taking the 2,500 rupees upfront. And he is telling me that, okay, fine, I am there to protect you from any kind of risk if the market reaches above 44,000. So I am there for you. So if the seller is taking all the risk, then obviously we need to respect the seller perspective of the markets, and we need to analyze the market from that perspective. So I have made myself very clear about the concept, and that is the reason, and that is the exact reason why when you trade in futures, both the parties are obligated to pay margins, exchange margins. But when you are trading in options, option buyer doesn't pay any margin amount. He just pays the premium. So if I am an option buyer, I will quickly go and buy 44,000 call option by just paying 2,500 rupees. If I have 2,500 or more than 2,500 in my trading account, I can do the trade. But if I am a seller, I cannot do the trading in just merely 2,500. So that is another way of looking at things. So this is very important. Why? Because the whole option analysis boils down to one thing, that is to understand the seller's perspective. That is why most of the market participants think PCR or option analysis as a contrarian analysis. So what you see, you tend to do the reverse of this. But after explaining you the whole concept, I think that you have a sense that this is in sync with the market and in sync with the option sellers. That is why if option writers are active in the market, more active in the market than the if call option writers are more active in the market than put writers, then obviously the markets will go down. Otherwise, if put writers are more active than call writers, then markets will go up. Fine. So let's begin understanding what all is available for you in this first section. Last price is the price, obviously the current market price, indicative current market price. It is just for your reference. You need to check your trading execution platform for exact codes. So this is the 330 data, so it will match with your trading execution platform. So 44,000 call option is trading at 98 rupees, whereas 44,000 put option is trading at 422 rupees and 95 paisa. Fine, that is done. You have open interest on both the sides. That means call side also and put side also. Why it is important? Because it presents the cumulative open interest, which has been created right from the beginning of the contract. So when the contract was created 3 to 4 weeks back. So the monthly contract was introduced way back 3 months back. So all the activity which is arising out of market participants are reflected over here. This is very important for two things: just to gauge the positional aspect of the market, and second, to gauge where my resistance and support lies. So all the things which are indicated in yellow are of importance. Anywhere in the software, whether you see in the stock side or the index side, anything which is reflected or highlighted in yellow has its own importance. And when I talk about open interest, call side highlighted is 44,000. You see 38 lakhs 52,250 open interest being highlighted. It becomes my resistance point. Resistance point is very important for your overall trading, just because you don't do any fresh trading whenever your market approaches either your resistance point or your support point. No matter how bullish you may look at the market, but you need to stop when you approach near to your resistance, and how good the weakness is in the market. You need to be very well aware of the fact that you need to stop when the market approaches your support level. So how to gauge whether a particular level is a resistance level or a support level comes from this point. So highlighted zone on the call side is your resistance. Resistance is 44,000 and support is at, just look at 43,500. You have 41,76,650 open interest being added over here on a cumulative basis. So this represents support and 44,000 represents your resistance. At this particular point, if Bank Nifty approaches either 44,000 or it approaches 43,500, you need not to do anything. Fresh position need not to be executed. And if you are holding the existing position, try to at least book partial profit or try to make some adjustment in the markets. Fine. So this is about it. What about change in OI? Change in OI reflects the mood of the market today. So even if your positional trade gives you a opposite direction, like today in this case, or traditionally the markets over the last 1 month have been quite bullish, but these 3 or 4 days have been bearish on intraday basis. So that is reflected over here in change in OI. So Friday was how it looked. All the greens you see are basically the call writing addition in the market. All the open interest addition will be reflected in green. All the open interest unwinding will be reflected in red. So as you can see, 44,000 put option has a unwinding data of 3,49,825. That means that around 3,50,000 participants unwinded their position or closed their position to give away their stand on the market. They were expecting that 44,000 will not be broken, but since it has broken, so they have decided to really close their positions. Fine. So this is very important for you to make your intraday trades. How it is important? We will be discussing it on the intraday data, where we'll be discussing PCR data and difference data. Fine. Sorry. Coming on to the change in change percentage reflects the change in open interest with respect to the previous day. So right now we are giving this change in change percentage for 3 active contracts, both on call side and put side. So as you can see over here, 43,600 yesterday the call writing, which was to the tune of 93 lakhs 35, sorry, sorry, 9 lakhs 33,550 was 311 times more than Thursday for the same contract. At the same time, 43,600 put option, which reflected as 15 lakh 65,125 was 305% more than yesterday. Fine. More than Friday. Oh, yes, more than Friday. Thursday, sorry, more than Thursday. Thursday, it had a very low percentage of open interest addition. On Friday, it was 305 times more than that. At the same time, 181%, 28%. So this gives you a better understanding of how my intraday mood is developing. Fine, we will come to it a little later on to understand the importance. Right now, it is the same thing. Strike price, you are very well aware of that thing. So now come on to the intraday data when you are wanting to trade on intraday basis. So as you can see, 330 data is matching. Like 330, you have the sum total of all the call writers and sum total of put writers. So what is the indication over here? 90 lakhs 35,175 is your call writers, and put writers are to the tune of 71 lakhs 12,725. So whenever I am trying to gauge the market movement, I need a complete past data to understand how the progression happened. So for that, we will be moving on to the Excel sheet once again, where I will be discussing the PCR data and the case analysis, various case, and how to do the trading on those cases. So this is yesterday's data of Nifty. Okay, so I might quickly give you the Bank Nifty data as well. So here is the Bank Nifty data. As you can see, I suppose. Yes. I think the values are clearly visible. If not, I will just make it a little larger. So now you can see that PCR is nothing but put writing divided by call writing. Put writing divided by call writing. It is coming out to be 0.7872, which is 0.79. PCR is put writing divided by call writing. And just remember one thing, put writing divided by call writing, if the output is more than 1, then it is a sign of positive market when you are noticing the option signal. Fine. So till the time you see that, like till 3:15, market was giving a buy signal. Why? Because my PCR was 1.16. Why it was 1.16? Because put writing was higher than call writing. So whenever you have a numerator of higher denomination and a denominator of lower denomination, then obviously the output would be more than 1. Fine. Otherwise, the output would be more less than 1. So right from 9:30, we try to analyze where the market is headed. So put writing at 9:30 was to the tune of 67 lakhs, whereas call writing was to the tune of 72 lakhs. So just look at the PCR. PCR was 0.94. Fine. 9:45, the PCR was at 0.87. 10 o'clock, put writing and call writing were at the equal footing. So you have a PCR of 1. Just look at that PCR of very near to 1. Then suddenly at 10:15 and 10:30, what happened? Look what happened. Put writing outnumbered call writing. So the PCR was to the extent of 1.5. And then the same thing happened till the time till 2 o'clock. 2 o'clock, see 1.5, 1.52. So that was the kind of buoyancy in Bank Nifty as far as the option data was concerned. So there are 6 cases of option analysis. I'll just quickly wind up this session, but I need to make you understand the different scenarios in which you need to take the trades. So the first scenario, I have 6 scenarios in place for the PCR. This is for the PCR. So first scenario is your bullish scenario. So this is your bullish scenario where the trajectory of PCR is rising in nature. So the PCR would go from one particular level to another particular level in rising trajectory. So this is the case from 1.2 to 1.6, 1.6 to 1.8, 2.1 to 2.6. This is a bullish trend, right? The first case is bullish trend when you see any PCR which is rising in nature like this. Fine. Otherwise, the second case is obviously the case where you have a PCR which is in decreasing in order and which is less than 1. Why less than 1? Because put writing is less than call writing. So 0.85 to 0.71, 0.62, 0.42, ultimately 0.33. So the graph would be somewhere like this. Perfect. Then you have a third case. Third case is your reversal. What kind of reversal? From positive to negative. Sometimes what you will see is market gaps up and it changes the direction. How to gauge the change in direction is ultimately decided by the third case. So whenever you see a PCR trajectory like this, like it starts from a positive side, 1.4 to 1.2, then it comes down to 0.9. Here you can see, and further it goes down. So it's a sign of perfect reversal from positive to negative. So positive to negative would mean that it is going from here, green side, to ultimately red side. This is red. This is green. This is positive. This is negative. So whenever you see this kind of a scenario from positive to negative, it is a sign of reversal, and you need to take into consideration all sorts of things while doing this kind of, when you see this kind of progression developing. Otherwise, the fourth trend is negative to positive. So at times market does gap down because of certain global things or certain stock related news or something of that sort, and then it changes the direction. So changes in direction from negative to positive. Here you see the difference. So these are the 4 cases where you can try and attempt some very good plain vanilla options, because there is a trend in the market. But the fifth and sixth case, where there is no definite trend in the market. So fifth case is where you have a positive side consolidation. Positive side consolidation would be likely where the market gaps up and it doesn't have any further trigger to go up or go down. So that is the sideways movement with a positive biasness. If you come across this thing sideways with a positive sideways with a positive scenario developing, then obviously you can do some good ratio spreads, call and put ratio spreads or credit spreads, which is indicated on the bullish side, or you can do a butterfly kind of a thing where you have a definite range to the range to the market. All those things were well discussed in the yesterday's webinar of Nitinji. So if you need those recordings, then obviously it is made available on the public platform. You can refer those recordings. The sixth case is obviously the negative consolidation, where you have a negative biasness to the market and the market turns sideways, as you have seen yesterday for the Nifty. There, in this scenario, you can do a bearish ratio, bearish credit spreads, bearish butterfly, or something of that sort. So all those scenarios are presented to you in much more effective way through your PCR. And difference data, why it is important? Because sometimes difference data also gives you a sense in the market. Let's go back to our software. Difference data gives you a sense where, like, look at this thing. 930, it was negative 4.4 4,45,000. It just came down to 14 lakhs. So starting from sorry, it is 4,45,000. Then it was at 14 lakhs. Then it sharply dipped to 17,000 at 10 o'clock. Then steadily rising from 38 lakhs, 51 lakhs, 62 lakhs. And it just had a sideways movement from 11 to say 300, 330 or 345. So you can very well see the kind of sideways movement the market represented yesterday. So this is all about option analysis. The option signal is buy when your PCR is above 1 and sell when PCR is below 1. Now coming on to the other aspect, which deals with future price action. Future price action is kept very simple. You have your VWAP, future VWAP, and you have your future price action. When you compare your future price action with your VWAP, you get VWAP signal. VWAP signal can be buy or it can be sell. VWAP signal will be buy when your future price is above your VWAP. So that means my future price is above average. So that gives you a buy signal. Whenever your future price is below your VWAP, that means it is well below the average or it is below average. So it gives me a sell signal. It's a sign of weakness. Why it is a sign of weakness? Because in a daily routine also we say the same thing, that you are below average or something is not right or something is weak. So we tend to say that it is below average. So how this VWAP is calculated and how it is much more effective than the traditional average, I'll just show you with another Excel explanation. So just concentrate on three price points. So market moves from 18,800 to 18,830 and 18,860. So what would be the simple average? Simple average would be 18,830, right? This is the simple average. Now, this can be easily changed. So now if the next move is 18,008, so 18,925. So it had a jump of 25 points or near about 25 points. Now see a scenario where we add volume to it. So at 18,800, say suppose 100 lots were traded. 18,830, some 60 lots were traded. 18,860, some 30 lots were traded. And at 18,925, some 10 lots were traded. So you can see, as and when the price increases, your volume decreases. So how it affects our volume weighted average price is simple. You multiply the lot size by the price action, it gives you a sum. And when you divide this sum by the total quantity, it gives me an average. So now you can completely see the difference. As and when the price increases and the contract decreases, my average is 18,824, not 18,853, which was reflected. So it is much more healthier way of looking at things. So how the progression of the price action is being taken care of by the number of lots is being reflected in VWAP. So if I do change, say suppose if I further go to 18,950 levels, so my simple average changes to 19,000. Oh, sorry, 18,950. So 18,073. But at this particular point, only 5 lots were traded. So how it changed, how it will change my whole setup, I'll just show you. So hardly any change in the VWAP. So VWAP only moved 3 points, whereas in the simple average, VWAP moved almost 20 points. So this is the beauty, and this is why we keep on suggesting to our subscribers or keep on suggesting to the retail clients that do consider VWAP as a very good stop loss mechanism or stop loss way, rather than to take future price action, option price action into consideration. So let's move back to our software and understand how to combine both these signals. Now you have option signal with you, which will give you option analysis, and you have your VWAP signal to give you future price action. So how to decide what to do in the market? So what to do in the market on an intraday basis? First of all, we need to understand that 10:30 is the best time to really think of any trading, because from 9:15 to 10:30, lot of emotional things are happening. Lot of things which may not be of relevance to you are happening, and it can give you a false sense of market movement. It can be a way to trap you in some way or the other. I can give you a very good logic behind why we do understand that after 10:30 the trade becomes very good. It's an example from a cricket field. where you see a test match being played. Sometimes the best of players also try to negate the first 1 hour of every day. The first 1 hour of every session is very much important, just because it gives you a sense of the swing in the day, how the pitch is behaving, how the bowler is trying to bowl the person out or something of that sort. They frustrate the fielding team. So lot many things they do as a professionals to make sure that all the dust settles, and then they make it much more easier for them to really perform. So at the same way you should also be doing, and the back testing result also shows the same thing, that after 10:30 trade probability increases with more confidence and conviction. So after 10:30 you should be looking, before 10:30 you should be analyzing the market. So how to do it, I'll tell you. So first of all, I've repeatedly said to you that derivative analysis is a combination of option analysis and your future analysis. So you need to combine the both signals. Whenever there is a conflict in both the signals, then you have to wait and watch for the next move. So we will just show you the things. Sorry. So 9:30, if you look at Bank Nifty, VWAP signal also was suggesting a sell, and at the same time your option signal was also suggesting a sell. Then 9:45 till 10 there was a sell signal, but at 10, look at 10, you have a sell signal at your option side, whereas a buy signal already been indicated on the VWAP. So there is a conflict of interest. There is a conflict between future price action and option side. So you need to wait and watch. Don't jump to conclusion. First thing before 10:30 you can do is that you can avoid taking a opposite stance. So 10:15 you had a buy and buy. Okay, so market is looking stronger from both option signal and VWAP signal. Now at 10:30 you are very much clear that market is bullish in nature. So first thing which you will do is to avoid all the bearish sentiments. Okay, so you will not trade puts, you will not short calls, or you will not be shorting futures or any other strategy which is bearish in mode. You will not do. You may not be doing any bullish scenarios, or you may not trade on bullish side, but you will not be doing any trade which is bearish in nature. That is one thing which is very clear at 10:30. So what to expect? Fine. So this is the second question. What to expect? How to select the strike price? At this point, what you can do is you can short puts. Put shorting is an option. It involves margin. It involves the strike price selection. So what puts you can short? I'll tell you. What puts you can short is, right now the market is trading at, look at the market. Market is trading somewhere around about 43,736. It is a future. Future has a premium of approximately 60 points over spot. So spot might be trading at 43,680 levels. Okay. So what you can do, you can just search the support level. Support level is at 43,500. So you can short all the calls, all the puts below 43,500. This way you could have made money. One thing. Fine. That is good. The second thing, you can go long in future. That is a perfect thing for you to do. But in case you don't have enough margin and you decide to go in for option buying, so the relevant option is call option. And just remember this theory, that in case you are trading on Friday, Monday or Tuesday, these 3 days, you can go in for one option above at the money, one option below at the money, and one option at the money. So you have 3 choices when you are trading on any day from Friday to Tuesday. Correct? Why? Because you have longer days to expire. But when you are trading on Wednesday and Thursday, just remember to trade in at the money options. And at the money options or close to money options, you can search on Google what is close to money. I don't have enough time. I need to really close this session also for all of you to relax and enjoy your weekends. So the thing is, close to money on Friday till Tuesday and at the money on Wednesday and Thursday. So, and that too from spot perspective, because expiry of option depends on spot price. So spot is 680. I can choose either 43,700 call option or 43,800 or 43,600. So if I choose 43,800, suppose, okay. So 43,800 I have chosen as. So what will be my stop loss? So I've clearly told you the stop loss will not be your option pricing. What most of the retail clients do is they tend to keep the stop loss at 25 or 30 or 40 rupees. So that can be easily triggered by large number of players, and they can bring back the option pricing at the same level as you have entered. So to mitigate that particular thing, you need to have a stop loss which is dependent on your VWAP. So now your VWAP is 43,665. And just remember one thing, that VWAP is average. So at times prices do come to the average and then bounce back. So you need to understand that you need to give some amount of flexibility to the overall trade. Fine. So the flexibility in terms of your Bank Nifty is to the tune of 50 points, depending upon the recent volatility in the market, and it could be 20 to 25 points in Nifty, depending upon the volatility in the market. So the flexibility over here should be 50 points. So 43,665. I should say that till the time my future doesn't reach 43,600, I will not going to exit out of call option. Fine. This is the thing which you need to apply when you are trading on option and you are taking the stop loss based on VWAP. So VWAP is 665. And remember one thing, if you think that the stop loss is far enough, then don't take the trade. Absolutely no necessity to take the trade if it doesn't allow under your risk profiling concepts. You can have another attempt at some later point in time where the prices come closer to VWAP and then you are trying to attempt. But aggressiveness or the moderate trader comes out of you as a trader, and no one can guide that. So if you are aggressive enough, then you can also trade in the same way. So now what would be the possible targets? Possible targets would be anywhere between, there are 3 basic concepts which we normally do take into consideration. First concept is when my option pricing increases by more than 50%. So if my option pricing increases by more than 50%, then obviously it is time to book some profits. So 50% would mean that 100 rupee premium becomes 150 rupee premium. First thing. Second concept is when it approaches my resistance level or support level. Second thing. Third, what is the difference between my future price and the VWAP price? Over here, my future price and VWAP price is to the tune of 80 points. So the first target becomes 80 points. Look at the future price. It is at 43,736 and 43,665. So 35 and 35, 70 points difference is there. So 70 points you can keep a target. And fourth way of looking at things, when your confidence just dies down. So at times there are certain situations where you think that, okay, market is not going anywhere. It is just sideways. So let me book whatever I am getting. So if it's 30 points or 35 points, that is a different story altogether. So let's begin. So right now at 10:30, you have taken the position till the time. Look at your PCR is more than 1.5 all the time. It is basically sideways. If you look at after 10:30, things turned sideways right from here. Look at 1.15, 1.46, 1.4, all the way your future price action was buy, but it the PCR was suggesting a sideways movement. Look at the sideways movement. So at this particular point of time, whatever you think is right for you, you can take the profit out of the market, because market may not go down sharply and may not go up sharply. So it is best you, whatever you get, you take and stay away from the trade. So this is what I wanted you to discuss. And the last thing which I want to discuss in this particular section before we move on to the yesterday's trade and further Q&A is that this is the pictorial representation of Bank Nifty. You can clearly see over here that 43,500, this red candle is put writing, green candle is call writing. So you can clearly see positionally 43,500 is a very good support, and over here 44,000 happens to be a very good resistance point. Fighting is going on over here from 43,600 to 43,900. Who will win ultimately will decide the market trajectory. This is from the positional point of view. From intraday point of view, what we can expect is, look at 43,500. There was on Friday, there was a lot more writing happening, and 43,000 yesterday writing happened, call writing happened at 43,800. That is why going forward on Monday, you will find the immediate resistance point would be 43,800. At the same time, there is a lot more fighting going on between call writers and put writers on 43,700 and 43,600. This is the phase where you need to make adjustments or watch it very closely for the next market direction. If call writers are very aggressive on 43,700, then your resistance point will shift from 43,800 to 43,700. And if the put writers are active, then obviously the market dynamics will shift to bullish phase. Same way we can discuss about Nifty. The same concept can be applied to Nifty also. So Nifty, you can see, look at Nifty. Nifty, there is a clear understanding that 18,800 is a very good resistance point. 18,700, there's a fight. So ultimately 18,700 will decide the next trajectory of the market from a positional perspective. Intraday yesterday, what happened was that there was a lot of call writing witnessed on 18,700, and there was and unwinding in 18,800 call option and writing in 18,000 put option. Oh, sorry, call option, and 18,000 put option was unwinded. So there is a clear-cut indication that Nifty, at least for a time being, is in no mood to break above 18,800. So this is the kind of analysis you need to make sure you understand. So now quickly, we can move on to yesterday's trade and then wind up the session. So this is how the Bank Nifty data was presented to you. At 10 o'clock, as we have already discussed, that the PCR was at 1, VWAP signal was at buy. This is the whole scenario. The put option writing, look at the put option writing and call option writing. Odin percentage. You can simply look at the Odin percentage and you will find a difference. Odin percentage was, or the percentage change. Odin percentage was in the older version, and newer version is your percentage change. So you can clearly see call writing in 43,800 was to the tune of 101. At the same time, 43,800 put option was at 94. The major difference was 43,700 and 43,600. You see, and you will notice that how things progressed and changed itself. This is the data from 10 o'clock. Let's move on to data from 10:30. 10:30. Look at the 10:30 data. You will see the difference. 43,600 at 10:30 was at 759% call writing, and put writing was 590. Look at the change. Put writing dropped from 759 to 547 levels, whereas there was an increase in put writing from 590 to 657. Right? Same way, 43,700, 243 become 281. At the same time, 286 become 404%. Look at 43,800, it was 101%. Oh, sorry. It was at 101%. It came at 130. It was at 94%. It came at 135. So now let's go one level up at 10:45. So how things are looking? Things are looking even better. Why? Because 547 become 488, 281 become 260, and there is a slight increase at 43,800 call option from 130 to 139. At the same time, 43,800 put option, 135 become 156, 404 become 141, 431, and 677 become 690. So this is the kind of confidence you get from analyzing individual strike prices at different point. And I was telling you that you can always short the put option. So I'll come across that particular thing also. At 10:30, if you could have short sold, if you could have short sold 43,500 or below put options at which was trading at 126, 43,500, look at the difference. At 10:45, 129, and then later on at the day, 132. It hardly increased. When the market moved along, it hardly increased. But then you see how call option did perform. So a lot of things were active in that particular thing. So this is how you analyze the individual data and make sure that certain things are in favor for you. Okay, this is the last thing which I want to discuss it with you. 43,800 43,800 was the call option, and it went up from 232 to almost 270. So that's